Welcome to the Deep Dive. If you're a professional driver, you are, well, currently riding an economic roller coaster where a safety bar keeps moving. It really feels like that sometimes.
Yeah.
One day you're celebrating a spot rate jump, maybe, and the next you're trying to decipher a global trade warning or figure out if, I don't know, a local fire just wiped out your chassis parts supply.
It's absolutely true. The job of a trucker has never been just about driving. Today, you are the front line of logistics, which means you need to be a market analyst, a regulatory historian, and a risk assessor, kind of all at once.
Right.
So our mission in this deep dive is crucial, I think. We are taking several recent, seemingly separate news items, things like tariff warnings, corporate mergers, funding freezes, and connecting them directly to your ability to make a living and, frankly, get a decent night's sleep.
We're here to distill the chaos, hopefully, into clear, actionable understanding. We've pulled from sources that stress one central idea, particularly from the folks at lifeiseater.com. The ultimate goal is getting out on your terms.
And that philosophy, it rings so true now more than ever. The greatest protection you have against the constantly shifting ground beneath you isn't just a powerful engine or, the cheapest fuel card.
Right.
It's preparation. It's the shield of knowledge you build against the economy and fluctuating freight rates. And, well, to build that shield, we have to look at every story from all angles.
Okay.
So let's start unpacking some unexpected good news first.
Okay, I know this feels like ancient history already, but let's start where the immediate money is, the spot market. We're finally seeing some green arrows. Rates just jumped. Drivers like Robert Valerio Trucking are reporting seeing way better rates overnight, apparently, and debt trend lines has confirmed a significant spike. It's the kind of sudden relief that makes you almost forget the past 6 months. Almost.
It is a sweet moment, yeah, but we have to treat the spike like finding a $5 bill in old jeans. It's a welcome, sure, but it's not retirement money. We need to identify the multiple forces at play here, and honestly, most of them are temporary or maybe even a bit misleading.
So what's the immediate culprit for the boost then?
Well, the initial boost was textbook stuff. We had the tail end of the Halloween retail freight push. That always forces shippers to pay premiums to get product delivered fast. Simple supply and demand there.
Okay.
But structurally, there are maybe two bigger drivers. First, the West Coast port systems are still under pressure, which drives up demand for inland deliveries.
Still. Oh,
Yeah. And second, and this is where the market gets interesting, I think, carriers are finally bailing on those garbage contract loads that just weren't covering costs.
Okay.
They're chasing the spot market just to survive.
That makes total sense.
Yep.
Carriers moving away from bad contracts puts immediate pressure back on the spot market. But I also heard the main theory was a capacity crunch, that the driver exodus finally made supply low enough to boost prices nationally. Is that truly happening, or is the jump more localized?
Well, that's the economics 101 factor, isn't it? Capacity reduction. When demand stays relatively steady and the number of available trucks shrinks, which it has dramatically over the last year because high operating costs forced smaller fleets, outrates must rise. It's just math.
So it's hitting nationally.
What's unique here is the speed of the spike. It suggests the driver capacity crunch has maybe hit a critical point nationally, not just regionally.
Okay, that's compelling data. But here's the reality check from the road. While the numbers look better, the general feeling is rates are up, but fuel's still killing us, and the anxiety is palpable. It feels like a trap, one driver noted.
And that anxiety is well-founded. Gross rates are up, yes, but net profit remains razor thin because inflation hasn't gone anywhere.
Still there.
Exactly. Fuel, maintenance, insurance, those fixed costs are just eating up the gains. If you're pushing 70 hours a week, a small rate spike doesn't compensate for the mental strain of constantly operating, on the verge of bankruptcy.
Yeah.
This temporary high, it kind of distracts from the deeper issues.
Which brings us to a threat that is anything but temporary. We need to pivot from this immediate spot market excitement to a massive, long-term global uncertainty.
Right.
The World Trade Organization, the WTO, they're issuing some serious warnings.
Yeah, and what's fascinating here is how these massive global policy debates tariffs basically become your immediate operating conditions. It's not abstract.
How so?
The WTO is concerned that aggressive tariffs being implemented or reinstated, targeting goods like steel, aluminum, electronics, and especially automotive components, well, they're going to seriously suppress global trade growth by 2026.
Okay, 2026. But for the driver who focuses on domestic freight, Why should a tariff war 2 years out matter right now?
Because it's a forecast of volume. Simple as that. Less global trade means a predictable drop in freight volume coming through every single port, from LA to Savannah.
Okay. Fewer containers.
Fewer containers mean fewer dray loads, obviously, and crucially, less imported goods like auto parts and electronics heading long haul into the heartland. This just compounds the supply chain fragility we'll discuss next. And if volumes drop significantly, overcapacity is inevitable. That kills rates instantly.
Yeah.
The driver comment sums it up perfectly. If China slows down, that's a domino effect from the ports to my paycheck.
Yeah.
It's an early warning signal, really, that your existing income stream might have a looming expiration date.
Okay, so if tariffs are the slow economic vice tightening things, the supply chain offers those immediate shocks. Like, I was genuinely surprised by the scale of impact from that New York aluminum plant fire.
Oh, yeah.
This wasn't just a local news story. It was a foundational disruption.
Exactly. This fire took out a Tier 1 aluminum supplier for Ford's truck and commercial vehicle division.
Tier 1. Wow.
Yeah, we aren't talking about small inventory losses here. Analysts suggest the resulting production loss could cost Ford up to $1 billion.
The billion. Good grief.
So what does that mean for the trucker? It means the vehicle you rely on, the commercial chassis you bought, or maybe the used truck you were hoping to purchase, it just got harder to maintain or acquire.
So if I run a commercial Ford fleet, how fast will I see this impact? Is it immediate?
Pretty much immediately, yeah. You can expect significantly longer wait times and higher prices for essential aluminum components, anything from specialty engine brackets to body panels, support beams, you name it.
And not just new vehicles.
No, not just new vehicles. It instantly impacts the aftermarket, too. We'll see parts inflation because the aluminum shortage just ripples through all manufacturing. And here's the kicker.
Okay.
This unexpected scarcity could ripple into the used truck market, driving prices up again because fleets can't get new units, so they'll hold onto or pay a premium for used ones.
Wow. It's incredible that one fire can have billion-dollar consequences and affect the price of a used truck 3 states away.
Yeah.
That kind of sudden fragility connects perfectly to the long-term industry consolidation, which often happens quietly, in a boardroom somewhere.
Mm-hmm.
Let's talk about Allison Transmission acquiring Dana's off-highway transmission business. Seems niche, but...
Right. This is a perfect example of a story that seems irrelevant maybe to the OTR driver, but is fundamentally important to their long-term operating costs. Why care about an off-highway merger? Because it's about control.
Control.
Yeah. Consolidation means fewer competing suppliers. That always leads to less choice in the market, fewer aftermarket innovators trying new things, and eventually higher prices for parts, especially expensive components like specialized transmissions and converters.
So Allison is strategically eliminating competition before the industry fundamentally changes with electrification. Is that the play?
That looks exactly like the play. They are locking in market share and supply chains now. This move squeezes out smaller builders and reduces the competitive flexibility that Dana previously offered.
Yeah.
And this is critical for you listening. If you are running older equipment, this merger absolutely affects your long-term repair viability.
So what should drivers do?
Fleet managers and owner-operators need to be proactive now. Seriously. Audit your assets, identify which parts are potentially subject to this consolidated supply chain, and if possible, stock strategic spares now before the price hikes truly kick in. Don't wait until you're stuck waiting 3 months for some proprietary converter because the market leader has basically monopolized production.
Okay, let's shift gears again. Let's talk about government policy uncertainty, which can cause its own brand of chaos.
Oh, absolutely.
We saw that instability recently with the Department of Energy, the DOE, pulling back a massive $7.5 billion in clean trucking grants. That's not a small cut.
No, that's a $7.5 billion industry freeze. That funding was basically the lifeline for adopting hydrogen infrastructure, expanding charging networks, and, most critically, grants designed to make clean tech affordable for small and mid-sized fleets.
Right, the ones who need the help the most.
Yeah. Exactly. With that money gone, you were priced out. Those smaller fleets trying to pursue cleaner mandates are now pretty much financially paralyzed, and major charging infrastructure projects are just grinding to a halt.
This political instability, it doesn't just delay things, it creates this investment paralysis, doesn't it?
Yeah.
If the government can just pull the rug out from under $7.5 billion, how can any fleet manager make a confident 5-year capital investment?
You can't. You really can't. You immediately default to the safest option, which let's be honest, is often running older, proven diesel equipment and delaying those costly technology upgrades.
Which slows everything down.
Right. It means the transition will be slower, less equitable for the smaller players, and ultimately more expensive for the entire industry in the long run. It's a huge signal that relying on promised government funding for technology adoption is, well, it's a gamble.
Okay, now let's contrast that big picture policy issue with a core operational hazard that happens every single day. The trucking company that was recently fined heavily over illegal construction waste hauling.
Yeah, this is a crucial lesson in legal exposure. This company got hit with a 5-figure penalty, which can rapidly become 6 figures once you factor in cleanup costs,
Wow.
for dumping mixed construction debris, including unauthorized hazardous materials, on non-designated land. The risks here aren't just financial fines. We're talking serious reputation damage, cleanup costs that could bankrupt a small operator, and even potential criminal charges.
And the unfortunate reality, as we know, is that drivers often face enormous pressure. Sometimes they are given bad directions, or maybe the broker simply misrepresents the contents of the load or the destination.
That happens.
How can the driver truly protect themselves? Just taking a picture feels like kind of thin protection against a 5-figure fine, doesn't it?
It does. You need to move beyond just common sense and into actual compliance documentation. The first line of defense is rigorous accountability. You must know your load manifest inside and out. What are you hauling? What are the restrictions? What does the official documentation say? Second, demand proper disposal sites and verify them. Don't just take someone's word for it. Getting a direction from a job site foreman is not enough.
Right.
You need to verify that the weighbridge ticket or disposal manifest explicitly authorizes the material and the location.
Got it. Document everything.
Document the load before and after the haul. Make sure photos are geotagged if possible. If there is hazardous material involved, you need to verify the hazmat placarding and documentation matches the material exactly. The goal is creating a paper trail, a solid one, that clearly proves you followed the explicit legal requirements, that insulates you from the company's mistakes or, a broker's pressures.
Okay, so that was quite a dive into the sheer volume of uncertainty you face. Volatile rates, easily offset by inflation, the long-term volume threat from tariffs, a ridiculously fragile supply chain proven by just one fire, political policy swings that freeze innovation, and very real legal risks every time you drop a load. All these separate stories, they really underscore one major lesson. Your livelihood is subject to massive, often arbitrary forces way outside the cab.
And that's exactly why the solution presented in our source material is so vital. We heard the philosophy earlier from lifesaTrucker.com. Truckers need to manage their time not just for shippers and brokers, but for themselves.
Themselves, right.
Knowledge is the essential shield, absolutely. But the ultimate goal is stability. And really, the only way to guarantee you retire when you want to is by creating some financial leverage for yourself.
We've established that relying solely on freight rates is, well, often a race to the bottom, especially when a WTO warning suggests trade volumes might inevitably slow down by 2026. So what's the specific strategy for building that leverage?
It's income diversification. Our sources strongly emphasize building online income streams, often utilizing new AI tools as probably the most accessible and effective shield right now.
AI tools.
Think about it strategically. The WTO is giving you a heads up that port volume will likely slow. The Allison merger is warning you parts costs will probably rise. This gives you a specific kind of deadline to start building an alternative recurring income stream that is entirely divorced from the spot rate market.
So instead of just generically advising diversification, we're tying the action directly to the risk. If I'm a flatbed owner-operator, how does building an online income stream actually counter a tariff-driven volume drop? Explain that connection.
Okay, because that income stream provides options. Simple as that. If spot rates drop to unsustainable levels, your diversified income provides the financial stability to maybe just sit out the bad market or refuse those garbage loads we talked about.
Right.
Or negotiate from a position of strength, knowing you have revenue coming in regardless of freight fluctuations. Maybe you use AI tools to quickly research and create specialized educational materials about, say, logistics compliance or even parts tracking for specific chassis types affected by these supply shortages.
Turning expertise into income.
Exactly. This turns your hard-earned operational expertise into a digital asset, providing a crucial layer of security. This is how you start to reclaim control over your time and your career path.
The knowledge that you have built a financial shield against a temporary rate hike or a tariff warning or even a $7.5 billion grant cut, That is the only path, really, to genuine peace of mind in this volatile industry. It's about being proactive, not just reactive.
Absolutely. Whether you're worried about parts inflation because of a consolidation or a policy freeze hitting tech adoption or simply the next market collapse, building exit options and diversifying your income is the smartest strategic move you can make right now. It transforms your career from a continuous struggle just to survive the market into a secure strategy to thrive outside of it, on your terms. Hashtag outro.
So, we've explored how one aluminum fire, one corporate merger, one political funding cut, and one volatile spot rate jump all connect directly to your bottom line and your peace of mind. The path forward isn't just driving smarter, it's about securing your future on your terms.
So here's a final thought to chew on. If the current market requires you to constantly be strategic just to survive a temporary rate hike, a tariff warning, and major parts delays, what fundamental long-term shift do you need to make in how you define your career so that your livelihood isn't constantly tied to the next fragile link in the global supply chain? Think about that as you plan your next move.